Well, welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. I'm Scott Tomlinson, and with me is my partner and colleague Paul Tepsich, the founder of High Rock. And today we are going to talk about our three asset models and any updates on developments in and around our tactical strategies and what we see happening in the global economy, in financial markets, and other issues that are pertinent to the world of wealth management. So, Paul, oil prices are now above $70, and that's the first time in 4 years almost?
Yeah, 3 years anyway. But and this is WTI, so this is West Texas Intermediate oil, so U.S. oil, which largely North America trades off of, and that's certainly what we see as a benchmark in North America. But if you go to the next, and actually we could probably say why. I mean, there are three main reasons why. Number one, Trump is supposed to announce tomorrow at 2 p.m. whether he extends the sanctions on or the Iran nuclear deal. I kind of think he's not going to extend that deal, so that's why oil has popped up a little bit here. Number two, Saudi Arabia, they're postponing their Aramco, which is a national oil company, it'd be the largest company in the world. They want to do an initial public offering and sell stock to the public for about 15%, I believe, and that's been pushed out from 2018 to 2019. Who knows where and when, but they're very incentivized to have oil trade higher before they do that initial public offering of a stock. And the third reason is Venezuela, which is a complete and utter mess. Actually, there's probably even a fourth reason, and as we have logistical and egress or transportation problems in Canada, they're starting to get sort of the same in the U.S., especially down in the Permian, which is down in the Gulf Coast area. Problems getting fuel to refineries due to transportation or lack of transportation, and certainly we have that. Maybe if you go to the next slide, Scott. This is Edmonton light sweet crude. So kind of equivalent on a chemical basis to WTI. And you can see how we've traded better as well over the last little while, and same sort of thing at a 3-year high. And then the final one, I think we have one more, that's WCS is Western Canadian Select. So this is commonly referred to as heavy oil. Heavy oil needs to be refined further than light sweet crude oil does, so it can be transported more easily and safely. But boy, this is really rocketed up, as you can see. I mean, over the past 2 months, it's gone from about almost $30 a barrel to 53 and change today. And I didn't put this chart in, but the interesting thing is, if you look at WCS or heavy oil in Canada versus WTI oil in the U.S., that discount in Canada was back in the winter in Jan, Feb anyway, it was $30 below WTI, and today it's trading at about $15, $16 below WTI. So there are a few reasons why both Edmonton light sweet crude and WCS have traded better. But our transportation bottlenecks have improved ever so slightly, but I think everybody is well aware of, if you're following the press at all, about the Trans Mountain pipeline, the other two pipelines that have already been canceled, and why it's so important to get this Trans Mountain to go through, because we clearly have a lack of transportation infrastructure in the country. Now, just on our portfolios, we haven't had a huge weight in oil. We've taken a little bit of profits over the last couple of weeks that oil has popped up. So we still have some exposure, but I think everybody knows we've not been all that enamored with what's gone on politically in Canada, and I'm still not all that confident about it. Certainly not enough to jump in with both feet. That's my oil discussion, I think, Scott.
Great, that was excellent. Thank you for that. Now, normally the Canadian dollar tends to move in some correlation with the oil price, but we've not really seen that lately. And I suspect, obviously, that there's a whole bunch of uncertainty surrounding NAFTA, and this is apparently a very crucial week in NAFTA negotiations, where Canada, the U.S., and Mexico have to come to some kind of agreement, and it seems like everybody's a little. Their negotiations are getting into sort of difficult times. So, is that partly why we think the Canadian dollar is weakening a little bit?
I think that's a big part of it, and I think the other parts are number one, economic. Seems pretty obvious. We've got an over-levered consumer in Canada, and I think that provides a bit of fear. I think the other thing that's kind of important over the past 2 weeks is the U.S. dollar has rallied or improved pretty substantially here, which I think makes sense. I'm not sure why it was trading so poorly and lower over the last, year and a bit, because quite frankly, the U.S. Central Bank, the Federal Reserve Board, was the only central bank really hiking rates, and at least it was the most aggressive in hiking rates. And when rates go up, it typically attracts capital to that currency because they can go buy the government bonds of that country that have increased in yield. So the U.S. dollar definitely has more of a positive tone or a bid to it. So that's hurting the Canadian dollar as well.
Yeah.
And we are still, long U.S. dollars in most client portfolios. We're looking for a place to add U.S. dollars for some newer clients.
On that note, talking about the U.S. economy, then last Friday we saw the latest data for the employment growth, which we, as you can see and as we've explained in the past, can be very erratic from a month-to-month basis. But we look at that pink line in the middle, and that is a smoothed out moving average over a 1-year time frame. So employment growth really peaked at the beginning of 2015, has trended lower until a bit recently, and it sort of looks like it's kind of moved from left to right in a flat kind of way over the last 3 or 4 months. But then again, we also look at the unemployment rate and the implications of unemployment. Again, we're looking at a U.S. economy that's at relatively full employment, dipping below that 4% number for the month of April. And I guess, Paul, historically, we look at how employment and the longer term or the 3-year moving average have interacted, and when they do cross, when unemployment crosses up through that 3-year moving average, we've historically seen a recession, but we're not anywhere close to that at this particular point in time. And even though we follow it, it's just something that we watch on a monthly basis when we do see the unemployment numbers. But it does look like the U.S. economy from this perspective still has a little bit more room. So that takes us... Sorry.
I was just going to say one important thing for our listeners is if they're looking at the unemployment rate in the U.S., which is at 3.9%, that sounds extremely low, and you can see it in the white chart. The white line on that chart. It's obviously low historically, but one thing to keep in mind is, and we don't have it here, we can put it in, is the participation rate is also very, very low. So what that means is a lot of people, and quite frankly, since the credit crisis in 2008, 2009, a lot of employees or prospective employees got very frustrated looking for a job and they dropped out of the labor force. So they're no longer part of that labor force looking for work. They're right out of it. They're not in the statistics. And the other thing too is it looks like unemployment is so low, but we have to keep in mind what the quality of those jobs are. So if the U.S. is hiring non-farm payroll employees of roughly 200,000 per month, you have to look at what kind of quality of jobs those are, and do they, are they high income jobs or are they low income jobs? And that matters as well. So you need to peel back the layers of the onion a little bit.
And because wage growth is not picking up to a large degree, the jobs that are being filled are lower paying jobs. I'm assuming that's the case in that situation. And we know from other information that we've received that there is still a demand for skilled workers that is unfilled at this particular point in time, right?
Yeah. And that's part of the problem down in the Permian Basin in the energy sector as well. There's a serious lack of reasonably skilled employees down there.
Right. So last week we were focusing a bit on the Canadian yield curve, and we had some great questions from listeners about exactly what the yield curve was about. I wrote a series of blogs over the last week or so, just trying to get a little bit more, hopefully some understanding of how and why we look at this yield curve and what it tells us. But we talked about the Canadian yield curve. Let's have a look at the U.S. yield curve. So since 2013, the U.S. Federal Reserve has raised interest rates quite significantly, going from 0 to now about 1.75%, and it is still expected that they could raise again. But interestingly, the longer term part of the yield curve, the 30-year bond yields, have actually come down from 2013 when they were higher. So we look at the potential for more rate increases and what that might mean. Well, Federal Reserve rate increases in the front end, how they affect the yield curve. If they tend to flatten the yield curve because bond investors in the long term think, well, that's good from an inflation perspective. Again, we don't need that premium over inflation when we invest. Then we could quite likely see longer term bond yields come down, and that yield curve starts to flatten. And when that yield curve does flatten, likely it will coincide with an upward tick in unemployment as we see the U.S. economy then be confronted with the potential for a recession. Any comments?
Well, yeah, we've shown that chart before too, but yeah. That's likely to happen. I think the bottom line there is that the Fed raises short-term rates too much, too quickly, too fast, and consumers who are levered, have borrowed a lot, mortgages, car loans, credit cards, etc., have a really hard time funding their interest expense, and it just slows down the economy entirely.
Yeah. And then it becomes cyclical in a sense that as the economy slows, unemployment starts to rise, and we move into a down cycle as far as the economy is concerned. And usually, as the U.S. economy goes in that direction, so too will Canada follow.
Yeah, rinse, repeat every 10 years.
Absolutely. All right, well, that's it for this week. Thanks for taking the time to tune in. Last week we had great feedback asking us about the yield curve, and it did give me lots of fodder for my blogs that I wrote last week. We certainly appreciate it and want you all to feel free to send more questions. We'll be back next week, but until then, we hope you have a great rest of the week and have a happy Mother's Day.